I think in the very near term, it's a challenging circumstance for most investors and speculators. I think we're beginning to see the delayed impact of higher interest rates around the world. I think, too, people continue to be nervous about the war in the Ukraine and newly concerned about circumstances in the Middle East. Two, there's a lot of political and social instability in the world. And there's a malaise in capital markets also as a consequence of higher interest rates. I don't need to tell anybody who owns long bonds about the impact of higher interest rates on the prices for the long bonds and disintermediation of the bond market. I think we're beginning to see a spillover of that into equity markets, particularly the larger equity markets, where rising interest rates reduce the capitalized value of income streams from dividends. All of those have conspired to produce difficult equity markets. Now, perversely, I love difficult equity markets. To me, a bear market is a sale. And what I'm seeing is that companies that I have wanted to buy for substantial periods of time, or at least stocks I've wanted to buy for substantial periods of time, but I've been unable to buy as a consequence of low prices, have corrected. So for me, as usual, the worst of times becomes the best of times. For people who don't have my patience, or for people who don't do the work to establish value, but rather practice the got a hunch, bet a bunch technique, these are and will continue to be tough times.
Rick Rule provides insights into the global market challenges, attributing them to rising interest rates, political instability, and social unrest. Despite these hurdles, he views difficult equity markets as opportunities, particularly in undervalued sectors. Rule emphasizes the potential in commodities, notably uranium and silver, advising patience for investors. He advocates for precious metals due to expected inflationary policy responses and expresses optimism about the industrial materials market in the long term. Additionally, he challenges the notion of fossil fuels' decline, citing their continued strength in the market. Rule suggests specific investment opportunities, such as Tech Corp for coal and ExxonMobil for oil and gas, anticipating their growth in the coming years. Stay tuned to uncover Rule's strategic insights on navigating these financial landscapes and maximizing investment potential.
I'm not exercising caution. I'm attempting to place capital. I note that the last time we visited, we spent a substantial time talking about uranium. And I said that we would pass into uranium bull market when the pace of Japanese restarts accelerated. That happened, and we're in a uranium bull market. Uranium is outperforming other commodities. I would use this not so much as an I told you so, but rather to reacquaint your audience with the fact that commodities that are out of favor are the commodities that you buy. One really, truly hated commodity right now, one that's disappointed investors for at least 3 years, is silver. So I'm starting to look for silver stocks. I like them when nobody else loves them. That isn't to say that you exit the uranium stocks yet. I think that uranium has at least a year to go in a bull market. If you're there, be right, sit tight. If you're not there, if you're coming into the space, you need to exercise some caution now. It's not a no-brainer, like it was the last time you and I talked. As to the broader question around commodities, I continue to be attracted to precious metals because I believe that the policy response to an economic malaise is highly inflationary. I see government deficits everywhere, even as I see it being more difficult to service those deficits with higher interest rates. I think the way around the political promises that have been made is to inflate away the net present value of the government's obligations, which is to say inflation. I saw it happen early in my career in the 70s, and I think I'm going to see it happen again. So I'm attracted both to precious metals and to precious metals equities, although some patience will be required. I'm attracted, too, to industrial materials, although I suspect that the next year will be challenging in the industrial materials market. I don't think a Chinese rebound has happened anywhere near as quickly as people would have preferred. And I think that you are seeing the delayed punch to the economy affected by higher interest rates, as well as caution in continental Europe as a consequence of war, and newly established caution around the disputes in Israel and Palestine. I believe longer term, however, that the market for industrial materials will return and will return in spades. I think that's true because I think we've underinvested in productive capacity for a very long time. And as world population growth continues, and as the material ascent of humankind continues, that the ability to produce that we currently have around several materials will be insufficient to meet current, let alone future demand. To be particularly bullish around fossil fuels, oil, gas, coal, things like that. The big thinkers in the world, the Justin Trudeau's, the Joe Bidens, my favorite energy physicist, Greta Thunberg, people like that to tell you that the era of fossil fuels is over. I would note that humankind has now spent almost 5 trillion US dollars in 40 years on alternative energies, and we've reduced the market share of fossil fuels from a high of 82% all the way down to 81%. $5 trillion has reduced fossil fuels market share by 1%. What does that mean? Oil and gas, stronger for longer. Coal, stronger for longer. Uranium, stronger for longer. Note, I'm not against alternative energies. I want to put them in their place. I'll add them to my portfolio when they're economic. But compared to, oil and gas and coal, the place in the sun will continue to be enjoyed, I think, by fossil fuels to the benefit of investors. So I'm not a trader. I'm an investor. I'm a speculator. And I've said this to Lobo. By the way, I have huge respect for Lobo, who's also a personal friend. It's odd that as old as I am, as little time as I have left on Earth, I've become very patient. I think in 5-year terms. The consequence of what Lobo has to do is that he has to think in quarterly terms. I think he has to do what he has to do, and I have to do what I have to do. I love circumstances where I think there's a high probability that I'm right, but the uncertainty revolves around time. I phrase it as asking a question where the answer begins with when, not if. I prefer when questions. Lobo, at present, given what he does for a living, can't afford when questions. I have a phrase I like to use that says inevitable but not necessarily imminent. I like things that are absolutely cheap. I like things that are relatively cheap. And the way you get them is to buy asset classes that are out of favor, particularly with impatient competitors. There are actually there's a fair number of coal companies. Investors to cover the waterfront would have to go to Australia. But Canadian investors in particular, I think should look at Teck, where the unbundling of the coal assets will provide a coal-related catalyst. That's a near-term theme that's playable. The market has discounted the value of Teck's coal assets, but the industry hasn't, which is why Glencore threw a takeover at them. Noted investor in Canada, Pierre Lassonde, is attracted enough about the assets that he's made an informal bid for the coal assets of Teck. So I suspect that the easiest way for Canadian investors in particular to play the coal space with a nearer term catalyst would be Teck Corp, not primarily a coal producer, but one where coal affects the immediate outcome disproportionately. I'm more attracted, frankly, to the oil and gas business because it's a bigger business, it's a better business, and it's easier to play. In that context, the biggest and the best name of all is headed a little lower in the near term, which is to say ExxonMobil with their recently announced takeover of Pioneer. This will put pressure on the stock. I think for people who have a 3 to 5 year outlook, as I do, that's a wonderful opportunity. I'm not saying it won't continue to lower for the near term in the context of weaker economic conditions, but this is a premier deployer of capital, firing on all cylinders upstream, downstream, refining and marketing, everywhere.
Throughout our discussion, Rick Rule shed light on the challenges stemming from rising interest rates, global political instability, and social unrest, all of which significantly impact investors globally. Despite these obstacles, Rule sees these turbulent times as opportunities, particularly for patient investors capable of identifying undervalued sectors in the market. He emphasized the strategic importance of commodities like uranium and silver, advising caution, but stressing the need to remain vigilant for opportune entry points. Additionally, Rule challenged the prevailing belief about the decline of fossil fuels, indicating their continued strength in the market and suggesting potential long-term investments. He also provided specific investment options, such as Teck Corp in coal and ExxonMobil in oil and gas, anticipating promising growth in the coming years. If you found this information valuable, don't forget to like, share, and subscribe. Hit the notification bell to stay updated with our future content. Thank you for watching, and we look forward to sharing more financial wisdom in our next video.